Yeah, I'm losing my edge.
Let's complain about bad shorts.
What a topical subject to cover today, because you have, and I was just fortunate enough to ACAT these into your account. You have some.
How that works.
You have some. Don't worry about it, because you're not moving them out.
This is like our CFO's friend tax. I'm gonna be paying to work here at some point. If you keep giving me your bad positions, I have to pay to be friends with you and our CFO. I'm getting screwed over here. What's going on?
You know what? See, that's that whole me attitude. Some people would look at this as a collective opportunity. You look at it only as, how does it affect me? So,
well, Pete, if I can bring your bad short positions back to profits on a day like today, where the small technology 60 is at all-time highs, and anyone who got short last week, from what I was talking about, I loved getting short that sticks product last week. Definitely has some bad short positions. If I can get them back to scratch or positive, are they my short positions still?
Sure. I'll let you keep them up until the point that they cover all my investments in Franco, and then take them back.
If it's not one thing, it's always something else with you, Pete.
Everybody in your pocket.
We have sticks here at all-time highs, which can definitely make shorts uncomfortable. I want to talk about 3 different ways to fix bad shorts that really apply to any market. It's just stocks here, as they, NASDAQ is back above 12,000. S&Ps are back to their all-time highs, and this sticks product is through all-time highs.
You would have thunk it, huh? Wouldn't you have bet? Wouldn't you have? I would have bet that, not that my short NASDAQs would have been good, but I would have bet that there would have been a little bit more digestion of the levels before we actually blew through.
I don't know what's with this would have. You keep saying would have. We did bet that there would have been more back in, but it's not a matter of this like a theoretical. We sold these markets, and we
were wrong.
We are in trouble, but thankfully we have some remedies for ailing short positions. A couple of defensive strategies that maybe none of these strategies are necessarily like reinventing the wheel, but people lose track of this stuff. I know how it goes when you've sold a stock or a stock index, or you sold gold earlier this year. This was a problem. You sold any market, and it goes through you. A lot of these concepts kind of go out the window, and all you can think about is this market needs to move lower or I'm screwed. A Tesla was a great example of this. If you traded Tesla from the short side at all in the last half a decade, you have inevitably gotten pushed to the brink of insanity. That trade. Oh my gosh, it's crazy. Thankfully, this sticks product, the small technology product and the small stocks, both of our stock market futures, they are small, and so you don't get necessarily a movement like you see in Tesla, where it's like, oh, it's $300 on Monday and it's $1,000 on Friday. It's more all-time highs in sticks means $100, $200, $300 loss in each of those contracts. But all of that being said, I want to talk about covering for a manageable loss, Pete, which people don't like to do, but it's something that you and you employ that on a daily basis, and it's not that you're not a loser for it. It's not because you give up on a position or two doesn't mean that your bottom line at the end of the year has to be negative. It's just the cost of doing business. And I also want to move on to buying highly correlated underperforming markets, and then also selling puts in the product itself or similar products. You don't have options on sticks quite yet, but there are super high correlated markets to sticks that you can create a covered position after the fact, even though it's already gone against you. You have all those things at your disposal here. But Pete, I think that this is probably the best one for you to talk to, because you're super active futures trader. You're putting on and taking off positions on a minute by. I hear your platform making noises. It's made 10 different noises since we've come on the air here. And,
sorry.
It's all good. But can you speak to this a little bit? It's a matter of using this underrated and underutilized strategy of simply taking a loss And that kind of quashes your bad short positions before they get out of hand. How do you, when you're entering a short position, like our example here, like the sticks at 54, last week you could have done it, or a couple weeks ago, sticks at 54, now it's above 55. How do you, one, set your management expectations for that loss? And then two, have emotions stay out of the way of making that decision? What do you do going into the position and then during the position to fix bad shorts with a loss management?
Well, I think you hit on the first. A key part is, and you learn this only through doing, a couple of basic things. If consistently, two things, and honestly, you only learn these by doing, and I did too. If you have on more contracts when you're having losing days than you would ever have on when you're having winning days, that is mathematically engineering without certainty defeat. So you have more losers on than you would winners. That is the first thing you want. So you want to think about a symmetrical amount of contracts you enter and exit on. Then the next part you mentioned, which was spot on, Frank, is I say non-denominational or whatever, but the investment in a trade, overinvestment in an idea causes you to tend to pick one side of that market that's frustrating you, and you don't feel you can trade both sides of the market. Now, I say both sides. I wouldn't be a buyer of NASDAQ up 400 points today, but I would be mindful that there is a trade at some point on both sides. So for me, the discussion starts, okay, I want this to be non-denominational. In other words, I don't want to walk away and feel so morally depleted. Hey, nobody likes losing money. And you do 5 of these diversified and they're all losers, which happens, nobody can engineer the outcome of any day. You don't walk away happy, but you come back the next day feeling like, okay, I'm ready to engage. I don't have an agenda that I have to get money back from.
Yeah.
The market takes, the market gives. So first of all, those are some basic management criteria that will hopefully prevent you from engineering a certainty of defeat. So the other one becomes in terms of strategy. What is my bias? Static deltas force you to have a bias. It's so interesting when I talk with Tom and Tony, they were always premium sellers. That was what that game was I shouldn't say always. Their trade started with selling premium, and then the hedge was the static deltas. For me, up until very recently, you either picked a side or you didn't play. So that meant you had to take a direction using static deltas or outright futures. And then that becomes, okay, I have a bias or a directional assumption I want to take advantage of. Is the market at a point where I can make the 2 key decisions? This sounds backward, but it's not. Where do I manage this if my strategy is wrong? In other words, my scenario doesn't play out and the trade is a loser. And then I worry about, is there enough in it basis what I'm willing to lose to make that trade make sense? So you've gone through 3 things and you could do it very quickly. Strategy, I have a bias. Loss management, is there a reasonable spot? And when I say a reasonable spot, if a market's moving like this and I'm only willing to lose 15 cents or 15 ticks, I picked the wrong market. The daily movement's too big. If it's at an interesting location where I can pick a reasonable level that the market sentiment has changed and I'm wrong, I can get out. And then looking at from that high to low in this example, the extreme, there's enough pullback room for me to generate a reasonable amount of profit against that loss. I've just set up that trade, and that's an interesting trade. You will be surprised going through those mechanics. You'll go through 23 or 30 markets that we have now, and you'll discount a good chunk of them based on that criteria right now. So you have to, and what that does is, what's the last piece of that? Discipline. You've had a strategy. You're going to stick to your strategy until the market tells you that you're wrong. And you have 2 actions that are predefined: your mechanics around loss and your mechanics around profit.
Sure.
Now, do we tweak them? Yesterday, Friday, I sold silver and I told you I was looking for 30 cents. Well, I got 20 cents and I covered them. I wasn't willing to wait for the extra dime, which would have, if I waited 10 minutes, I would have gotten. But that's as mechanical as you can get. So you stay independent of bias past a certain point, and you manage an appropriate amount of loss against winners. So those are all kind of the mechanics you got to go through each trade. So looking here, we've sold them poorly. We've gotten a little bit of pullback. Probably would have sold these, would have managed them for 80 ticks. That might have been profitable, but would have reloaded on the sales at probably 54 or below that, looking to trade again this
Sure.
new range. So now I'm at an inflection point of I'm out 120 points on the trade. Was I looking to make 120 points on the downside? No, I wasn't looking for that kind of pullback. If I was only willing to risk 20 ticks, is this the right trade? No, there's too much wiggle room here. So you have to start thinking about this trade. If I had sold anywhere between 53.90 and 54, I would have been out with by now. And now for me, the next trade is we found new hunting grounds. Fair enough. Where do I want to put this trade on? Just from my personal, and it works differently for everybody, I'd like to see a little bit bigger extension to 55.5 or $56. Then look and rinse to repeat to see if we found a new tradable range.
Yeah, absolutely. In this example, you got short at 54, and if you said at the outset of the trade that I'm going to take $1 on either side and get out, then yeah, you maybe were able to get profits. If not, here's the nice thing is that you would have gotten out for a loss at 55. The market is now up to 55.5, 55.60. And so you would have been able to get out for that $100 loss, not a $150 loss. And you would have been able to get back into that market. Because here's the thing, Pete, like you're speaking to professionals, whether it's you, a professional kind of trader who's got his own opinions that are pushing and pulling his positions tab here in his trading platform, or professional market makers, everybody takes losses. The difference between, making that step to being a professional or being an amateur who's just, spinning their wheels is not having emotions around those losses.
Absolutely.
Everybody takes those losses and they just say, like you said, at the outset of the trade, I'm either winning $1 or losing $1, 53 or 55. And guess what? When I get out here for the loss at 55, I am not angry about it. I'm not, saying, oh, I'm going to give myself another 10 cents, another 20 cents. I'm getting out there. And then on a day like today, pressing through those highs further, you have an empty platform tab that allows you to get short into a new trade and have missed everything between 55 and where the market is now north of that. Going on to a couple other ways to fix bad shorts here, you can look at highly correlated but diverging markets like S&P 500 that's got about 25 to 30% difference between that market and the sticks that are making all-time highs today. Small stock 75, the other small exchange equity market, closer to 30% difference there. Those two markets diverging, but having a correlation that is very positive and high. And then you get all the way down to energy, less high of a correlation, but still positive and still made up of stocks similar to the sticks product there. But you've got this extreme of about 70, 80% difference in 2020 performance. And you can go to those, Pete, and simply you make two decisions. How much of the position do I want to hedge? If I'm short one sticks contract, it's worth about $5,000. So if I want to hedge 100% of it, one SM75 contract at about $5,000 can do that. SPY, that's a product that's about $340 per share. I can hedge 50% with 7 shares, or XLE, I can, it's I think about $30 per share. I can hedge 25% with 40 shares. And these all look like random numbers because they are, for the most part, random numbers, because what you have to decide on is which of these markets do I want to use, and then which percentage do I want to apply. And after that, it's some pretty simple math, because if I want to use XLE, but I want to hedge 50% of my short exposure here, it's just a matter of buying enough XLE shares that account for $2,500, because this contract is 5,000, 50% of it is 2,500. And so then I need enough shares to make up that $2,500. And this is the first step. It's not in my mind, the best way to fix an ailing position. But Pete, you can create a positive, product that's in there, that's green, that was red, by buying these underperformers and hedging part or all of the risk.
And yes, and guys, from my experience too, is I usually don't decide at some point I'm going to Band-Aid 100%. I will look to kind of, if as traders, we always say split the difference, obit at 2, I'll buy or sell the ones. I will look to mitigate half of that depending on how aggressive I want to be. But that way you kind of get the best of both worlds. You're maintaining your assumption as long as you feel you're at a reasonable point, and you're slowing, no guarantee, but statistically you're slowing the pace of that loss down. And then you can look at adding either more of the hedge or removing the hedge. So I think this is the perfect next step. So we talk about management of a single underlying. Now we're talking about bandaging it with correlation and extremes, which we know statistically helps us get away from, that first choice is a 50-50 world. Here we're starting to get away from the 50-50 world because we're playing a little bit on the statistics around the propensity for correlated assets to revert.
Absolutely.
But the best choice.
Yeah, the final stop here, and something that is probably the best way to, like Pete said, band-aid a bit of a broken position, or just fix one of these shorts that you're kind of stuck in, that you don't want to get rid of necessarily, but are definitely making you feel more uncomfortable by the day, is to go to a market like XLK, which is one of the highest correlation markets to sticks here, and sell some options in there, creating a covered position. If you've ever heard of a covered call, this is that strategy, just opposite direction. So you're short this sticks market, you're short $5,000 worth of technology stocks. I can go into XLK options, which options are on 100 shares. So 100 shares of XLK gets you to about 12 grand. But thankfully, you can go to out of the money options. You could go to the 20 delta put and hedge, in theory, about 50% of the position, or I guess it would be closer to actually 25% of the position at the money options. Oh, no, I was right. Yeah, 50% of the position would be about a 20 delta put. At the money puts would be equivalent to about 6 grand in
a slight overhedge, right?
Yeah, so a slight overhedge against the short position. And then the short put spread is probably my favorite for an instance like this. I would just go into XLK and go to the 30 delta put, sell that, and then buy the 15 or 10 delta put against it. And that will create a situation where sticks, you still want sticks to move lower. You're short that futures contract, but it can move lower slightly or not at all. And the options that you sold against it can bring you back to a scratch, or even bring you back to profits if that market doesn't move at all or move slightly in your favor. Best case scenario, when you've sold sticks, it's moved higher against you, and then you sell these options, is sticks comes down a little bit, but technology doesn't fall through the floor there, and you make money on both ends. But those are 3 different ways to fix bad short positions. The easiest and the most active trader way to do it is to simply say to yourself, I'm going to trade 10 times today, or 100 times this month, or 1,000 times this year. And so, yes, I'm going to have to take losses, just not letting those get out of hand or emotional about it. And then the next thing is to kind of create a pairs trade out of these ailing positions. And then finally, you can create a covered position here by being out some money on your short, and then appending it with short options that hedge part or all of the risk after the fact. A few different ways to fix bad shorts.